So now I want to look at changes in supply. And before we dive into the changes in supply, let's look at what causes a change in demand. So just a little bit of a review here. So when we talk about changes in demand, we're talking about those determinants of demand. Right? We're shifting the demand curve. Demand, supply, equilibrium, price, and quantity. And we're talking here about what would cause a change in demand. What would shift that demand curve, change the amount we're willing and able to buy at every price. And of course, that change in demand will change that equilibrium or market price, because it means that at the current price, we are no longer at equilibrium. We now have a shortage or a surplus, and we know from our previous discussions that shortages and surpluses cause changes in price until we find that new equilibrium. So before we dive into what changes supply, let's just quickly recap, see if you can remember off the top of your head the 6 things that change demand. So the first one is a change in income. Okay. The second one, change in preferences. Sometimes we lump that together with quality, because if there's a change in quality, it changes how much we like, how much we're willing to buy. Other things that change demand would be expectations of future prices. Okay, so if you expect the price to go up in the future, you're going to stock up now. That will increase the current demand. We have expectations of future income. You think you're going to get a raise, so we tend to spend it now before that income is even changed. And so that increases our demand as well. So an actual change in income or an expectation that your income will change your current demand. All right, what else are we missing? Okay, we have income, preferences, expectation of future prices, expectation of future income. We have number of buyers. So if we have a change in demographics or population, so more people are now willing and able to buy, that will change demand. And the last one here is the price of related goods. So how are goods related in the mind of the customer? They can be complements or substitutes. We're going to talk about price of related goods in the mind of the business in just a minute. So it's important to note here how we're referring to related goods in the mind of the customer. We're calling them complements and substitutes. So now let's look at supply. Let's look at the business perspective, okay, and what changes supply. We're also going to have 6 determinants of supply, 6 things that shift the supply curve. And price is not one of them, because a change in the price of craft beer will change the quantity supplied. We're simply moving along the supply curve if we're changing price. The rest of these will change the whole relationship between price and quantity supplied. So the 6 things we're going to list here are going to change. Of course, I seem to be at the edge of the writing area here, are going to change the amount that businesses are willing and able to sell at multiple prices. Okay, so we're looking at what shifts the supply curve, what changes supply. Let's make a list. Number 1, the number of producers. So if we change the number of companies that are willing and able to sell, it's going to change supply. Because remember, market supply is adding up the quantity supplied from all the different companies at each price. So let's draw a graph here, demand, supply. Okay, let's assume the market price right now for a large pizza is $20. And at 20 bucks, there's a certain quantity in Red Deer that gets sold. Now, what happens if a new pizza joint comes into town? Are we changing the customer or the business? Here it is the producers or the businesses that are changing. We now have more producers. So what that means is that at $20 for a large pizza, the amount that collectively these businesses are willing and able to sell is now higher. Notice that point is not on the demand curve. It is not on the supply curve. What we've done is we have increased supply. So when the number of producers go up, the supply will go up. It's a shift to the right because the quantity has increased at the price. Now what that means is there's now a lot more choice for where you get your pizza. And here, quantity supplied is more than quantity demanded. So what do we have? A shortage or a surplus? At the $20 price, quantity supplied is more than quantity demanded. We have a surplus of pizza, and that surplus is going to push downward pressure on the price until we end up at a new equilibrium. And this is why we know when we have competition, the more competition there is, the more the price falls. And it's because at the old price, quantity supplied is more than quantity demanded. We have a surplus pushing downward pressure on the price. So number of producers increase, supply increases, which is a shift to the right, and it's going to push the price down. Well, what happens when businesses go out of business? So for example, in Red Deer, just a couple years ago, Future Shop closed. So when it comes to places to buy TVs, Best Buy, Future Shop, Visions, and so on, there's now one less producer, one less company in the market. In that case, here's demand, here's supply. What's changing? Customer or business? Well, it's a change to business. There is now less quantity available at the current price. So what we have here is a decrease in supply. The less competition there is, that means the customers want more than is available. And we know when there's less competition, what tends to happen to the price? It goes up, and we can see that here because quantity demanded is more than quantity supplied, pushing up pressure on the price, and the price goes up. We're at a new equilibrium. So number of producers will change supply. The second thing that changes supply is a change in technology. So why would a business take on new technology? Well, you take on new technology in order to be more productive. When we talk about productivity, we're talking about being able to make more. What we really care about, more than can you make more, is are you more efficient? If you are more efficient, you can make more with less. So really you want to know about bang for your buck. Are we getting more with less resources, less cost, less expenses? So businesses will adapt and take on new technology in order to be able to make more with less. Well, what does that do to the quantity sold and the price in the market? Okay. Well, here's our equilibrium price, and here's our equilibrium quantity. The business is now able to make more at the current price. Okay. They're able to make the current quantity at lower cost. So what we've done is we've shifted the supply curve here to the right. The business is able to make more with less. And that means that at the current price, they're now making more. Quantity supplied is higher than quantity demanded. That's going to put downward pressure on the price. And we're going to end up here at a lower price as our new equilibrium. So equilibrium is always where your demand and supply intersect. So look for your new supply curve, or if you have a new demand curve, you're looking for that. All right, number 3. What happens if there's a change in the price of related goods? Now here we're looking at it in terms of related in the mind of the business. So we add this in production term to our substitutes and complements to tell us that it's in the mind of the business. So let's look at some substitutes in production. And I'm just going to create a whole another page so we have lots of room. Okay. So let's look at 2 goods here. Demand, supply, demand, supply. Now, if these are substitutes in production, that means that in the mind of the business, they can make one or the other. So let's suppose that you're a farmer and that you can use the same resources to make lettuce or tomatoes. And I apologize if you are a farmer, come from a farm family. Lettuce and tomatoes, if they don't use the same amount of water, fertilizer, resources, it's not an accurate necessarily example. But let's just do a simplification. We'll assume that lettuce and tomatoes use the same resources. So if they use the same factors of production, they are substitutes in production. We could make one or the other. Now, let's suppose that in the lettuce market, everyone has been talking about how good lettuce is for you, okay? So lettuce is now this wonder vegetable everyone needs to have. So there's a change in preference. A change in preference, does that change demand or supply? Well, if we're changing consumer preference, we're changing demand. So we'll increase demand here. So if we assume that there's an increase in demand for lettuce, what will happen? Well, that increase in demand for lettuce means that at the current price in the market, customers want more than is available. So do we have a shortage or a surplus of lettuce? We have a shortage. Quantity demanded more than quantity supplied. That shortage is going to mean the price of lettuce is going to do what? It's going to go up. So demand for lettuce went up, price of lettuce went up. All right, let's assume this is the current price and quantity of tomatoes. Now, as a farmer, you can use your land and resources to make lettuce or to make tomatoes. Well, you see that there's that increase in demand for lettuce and a higher price at which you can sell your lettuce. So notice here, we haven't changed the supply of lettuce at this point in time. We're changing quantity supplied of lettuce. We're moving along the supply curve because at higher prices, businesses are willing and able to sell more. So that higher priced lettuce changes quantity supplied, not supply. But what happens in the tomato market? Here's the price of tomatoes. But as a farmer, you're thinking, if I can make more profit off of lettuce, I'd rather do what? I'd rather make and sell lettuce. So what happens in the tomato market? Well, we don't see a change in the tomato price that's driving this change. It's a change in the price of our substitute in production. So what happens then is at the current price of tomatoes, you don't want to make and sell as much because you'd rather be selling lettuce. So notice that point is not on the supply curve. We've created a new supply curve. Okay, I think I've run out of batteries on my on my pen, so I meant to stop this video and resume it in a minute. But what we have is a decrease in supply of tomatoes. So a shift to the left. So supply, see if I can make this work, decreases. Nope. Supply decreases, and that causes the price of the tomatoes to be driven up as well. So when the price of lettuce goes up, a substitute in production, it's going to cause the price of tomatoes to go up as well. All right, I think we've gotten our technical difficulties fixed. So where we left off is supply had decreased. That creates, at the old price for tomatoes, that creates a shortage, and that drives up the price. Although I think I've left my all right. Gotta have this little handy glove here, or else it makes weird marks all over the page. All right, so when we have that increase in demand for lettuce, it drives up the price for lettuce. Because they're substitutes in production, that causes a decrease in supply for the tomatoes and drives up the price of the tomatoes. All right, so we were looking at number of producers, technology, and our third was the price of related products. So we looked at substitutes in production. Let's now look at complements in production. Complements in production are when you go to make one good, the leftovers make something else. So for example, let's suppose you are a cattle rancher. So let's do demand and supply, and let's look at hides and beef. So here we have the equilibrium price and quantity sold of hides, and here we have the equilibrium price and quantity sold for beef. Now let's assume that it has become very popular and cool to wear leather. So there's an increased preference for leather, which means there's an increase in demand for hides. At the current price for hides, the quantity that customers are willing and able to buy is now higher, so that's that higher quantity. And that means that at that current price, we are no longer at equilibrium. Quantity demanded is more than quantity supplied. So we have a shortage. So demand went up. Demand went up, caused that shortage, which caused the price of hides to go up. Well, you are a cattle rancher, and you're looking at the fact that you can now sell your hides for a much higher price. So what do you want to do? Well, you want to sell more hides. Well, in order to sell more hides, what are you going to need? You're going to need more cattle. So what happens is that in the beef market, there's a change that's not driven by the price of beef. Because if we want to sell more hides, we need more cattle. And if we're going to take the hides off the cattle, we can't just keep letting them roam around afterwards, right? You can't just shave off some of the hide and then have your cattle keep going. So it changes what happens in the beef market, because beef is the leftovers, the rest of the cow, after you remove the hide. So what's happening here in the beef market, is that a change to the customer or a change to the business? Well, it's a change to the business, and what's happening is that because we now have more cattle being slaughtered, the supply, what is going on here? Having technical difficulties in this video today, huh? The supply increases. And that means that at the current price for beef, we are no longer at equilibrium. The amount that customers are willing to buy is less than the amount that businesses are willing and able to sell. So we're not at equilibrium. We now have quantity supplied. We now have quantity supplied more than quantity demanded. Quantity supplied more than quantity demanded. So we have a surplus at the current price, and that surplus is going to put downward pressure on the price. So the price of beef is going to fall because of that surplus. So an increase in demand for hides caused the price of hides to go up. That caused the supply of beef to increase, since when we produce more cattle for hides, we end up with more cattle for beef, and it puts downward pressure on the beef. So it really depends on how the goods are related. Maybe that explains our technical difficulties here. I think our program just crashed. So it really depends on how the goods are related in terms of what happens to the price of one good relative to another. So when we looked at the price of substitutes in production changing, we looked at the price of substitutes in production changing. When the price of one went up, that's the wrong one. When the price of one went up, the price of the other one went up. When they were complements in production, then when the price of one went up, the price of the other went down. So it's important to know how the goods are related. All right. View. See if that crash of our program changed anything here. So we're recapping. We have number of producers, technology. We have the price of our related goods. Substitutes in production use the same factors of production. Complements in production, one is the byproduct or the leftovers of the other. The fourth thing we want to look at in terms of what shifts the supply curve is the cost of inputs. So these are our factors of production, and they are how we pay for our factors of production. So what were the factors of production? We have land, labor, capital, and enterprise. So how do we pay for land? What's the economic term? Rent. How do we pay for labor? That's wages. How do we pay for capital? The economic term is interest. And remember, when we're talking about capital, we're talking about real capital, machines and tools. We're talking about human capital, that knowledge, know-how, work experience, education that makes the worker better. So we have real capital, we have human capital, and we have intellectual capital. Financial capital is not a factor of production. Money buys things, it doesn't make things. But the term we use for how we pay for our real capital, our machines, is interest. And then finally, how do we reward our entrepreneurs? With profit. If any of your factor payments change, this will change the cost of production and will change supply. So let's say demand, supply, and let's suppose that you run a movie theater. You don't play new movies, you play older movies. So let's say that you only charge, say, like $2 for those movies. So the price of your product is $2. There's a certain number of customers you bring through in a month. So we'll set that quantity as Q. Now, what happens when they change minimum wage? So now we're changing the cost of our labor. And in Alberta, minimum wage in 2015 was $11.20. In 2018, it went to $15. And this video was made in 2020, where it's still $15. So what happens at the movie theater when you change the cost of labor? Well, at the current price of $2 for a movie, we have a certain number of staff who are helping us run that production. So is it costing us the same to show that movie as it did before? Well, if we are using the same number of workers, it is now costing us more to produce the same number of movies and have the same number of customers come through the door at our movie theater. So at the current quantity of attendees at our theater, the cost is now higher, so we can't maintain that same profit margin at $2 a ticket. So because of that increase in cost, we actually, in order to produce the same number of movies and guests, we need to charge a higher price. So notice that point is not on the supply curve. The supply curve has shifted to the left. So we have a decrease in supply. We have quantity supplied less than quantity demanded at the current price. We get upward pressure on the price, and we end up at a new equilibrium. Notice that new equilibrium is not up here. It's not the same quantity. So what happens is as you raise the price on your movie theater ticket, less customers are willing and able to buy, so the quantity actually goes down. And so we don't actually get to charge the full amount of that higher price. We're not up here because customers are not willing to go and visit the same number of movies when we've raised the price. So what happens is a compromise between the two. And so the price goes up a little bit, but it can't go up the full amount because customers are less willing and able to pay at higher prices. So we end up here at this new equilibrium. So what happens is the cost to the business goes up, and some of the cost is just eaten by the business, and some of the cost is passed on to the customer. How much goes to the customer versus the business, we'll look at later in the semester. So when we raise minimum wage, does that automatically mean that the prices of everything go up? So is simply raising minimum wage just driving up inflation because now the prices of everything have increased? Well, remember, we have multiple determinants of supply: the number of producers, the technology. So if there are more businesses that are hiring people, okay, that will increase supply, whereas that increase in cost, because of the higher minimum wage, will decrease supply. So it doesn't necessarily mean that when you raise minimum wage that you instantly have inflation and everyone who got higher wages is back to where they were before because everything costs more, right? Wage went up, but so did the cost of everything. What we see is that when you raise minimum wage, and you don't have a growing economy, so we don't have more businesses starting up, or you don't have the companies being more efficient. So if we can actually make more with less workers, then paying higher minimum wage doesn't end up just making everything cost more, and then the person who's making minimum wage is no better off. If we can get more efficient, or we can get more growth, then the people who are getting that pay raise will be better off. But if we're simply raising minimum wage without the growth, without the more efficiency, then what happens is you raise the minimum wage and the price of the products go up as well. And so the person making minimum wage, if they've kept their job, they're going to have higher costs as well. And we know that as you raise the cost to the business, they can't afford as many workers as well. So minimum wage can impact unemployment. In macroeconomics, we'll look at this in more detail. But really what we're focused on right now is what changes supply. Number of producers, change in technology, price of related goods, substitutes in production, complements in production, A change in the cost of inputs, which can be a change to the cost of land, labor, capital, or enterprise. So we're talking about those factor payments. If the costs go up, supply will decrease or shift to the left, then the price of the product will increase as well, but not the full amount of the cost. The fifth thing that shifts the supply curve is expectations about future prices. So this is the price that the business is going to sell their product for. Let's suppose that you manufacture furniture and you're expecting there to be a higher price in the future for furniture because there's been a huge influx or expected to be a huge influx of people moving into your area. And all of those people moving in are going to need furniture. We have not yet seen the change in demand because of the number of consumers that would actually elicit the increase in price. But you're expecting it to happen. So right now, here we are at the current price and current quantity. If you expect prices to be higher in the future, because you expect that increase in demand to drive up the price, you have to make a decision as to what to do right now at the current price. Well, one option is to stockpile. That is, you're going to take your furniture and not put it on the market right now. You're going to hold on to it so it's not currently in the market, and you're going to sell more of it in the future when you expect those prices to be higher. Well, that means that the current supply in the market is going to be less. So less quantity available at the current price, a decrease in supply. So that decrease in supply, because we're stockpiling, means that there's now a shortage at the current price, which will drive up the price. Okay, so you expect the prices to increase in the future. You hoard it now, you release it in the market later, and it actually drives the price up itself. We can see the Organization for Economic Cooperation and Development, not the OECD, let's try that again, OPEC, Organization for Petroleum Exporting Companies. So this would be a number of countries in the Middle East, Saudi Arabia, Kuwait. They produce oil. Well, they can stockpile their oil, so not put it on the market. That'll decrease the supply. What they're trying to do is drive up the price. Okay, so you can see how that works here. Now, if we expect future prices to be higher, another alternative would be to ramp up our production, especially in industries where your product can't just sit on the shelf or in a warehouse. So let's suppose that you're expecting these reports to come out from medical research that talks about how healthy eggs are for everyone. So we're anticipating that there's going to be a huge demand for eggs in the future. Well, at the current price in the market, there's the current quantity that is sold. Demand hasn't changed yet. We don't see a bunch of more customers buying eggs, but we expect there to be more demand in the future, driving up the price. So what do you do at the current price? Well, we could start ramping up production. So in anticipation of that increase in demand in the future, we could start getting more chickens, producing more eggs. And as we produce more eggs in anticipation of that higher demand in the future, what we've done is increase the supply. Quantity supplied is now higher at the current price. The challenge with that, of course, is it creates a surplus that puts downward pressure on the price. So if that increase in demand doesn't manifest itself, your expectation of higher prices will actually result in lower prices. So what happens when you expect higher prices in the future? It depends on if you are stockpiling, so pulling it off the market to sell later, or if you're going to ramp up your production in anticipation. So if you increase the supply, that'll put downward pressure on the price. The sixth thing that changes supply is business taxes. And this one ties a bit to those changes in the costs of production. So when we look at taxes on businesses, it is impacting the cost for them to produce. So here's demand, here's supply, here's the price, here's the quantity. So we could look at things like the carbon tax. We can look at sales tax. So all of these are incurred by the business. The business is the one who pays the tax. So in the customer's mind, it is wrapped into the price. So it is not a change in demand because in the customer's mind, it is only a price change. And price changes quantity demanded, not demand. So when we look at business taxes, sales tax, carbon tax, they are changing the cost for the business to operate. So if the current price is $1 a liter for gas, and we're adding a 5-cent tax, what that means is for the business to sell the same quantity as before, right, they would need to charge $1.05, add that 5-cent tax. But the challenge here is that the customer is not willing to buy as much, the more expensive it gets. So we see here a shift in the supply curve to the left. At the current price, quantity demanded is more than quantity supplied. We have a shortage. The shortage drives up the price, and we end up at a new equilibrium where the extra tax is shared, right? It's not the full amount passed on to the customer. It's shared between the business eating some of it and some of it being passed on to the customer. So business taxes, because it's an additional cost to the business, decreases supply, drives up the price. So we've looked at number of producers, a change in technology, the prices of related goods in the mind of the business, substitutes in production, complements in production. We've looked at changing the cost of the inputs, those factor payments. We've looked at expectations of future prices and a change in business taxes. These 6 things change supply. They shift the supply curve to the right if it's an increase in supply. They shift to the left if it's a decrease in supply. Notice that none of these were the price of the product themselves. A change in the price of a product is a movement along the supply curve. It changes quantity supplied.